Welcome to the weekly roundup. This last week, we had returned between $2,000 and $6,000, depending on how you managed our systematic trades. Now, a significant amount of the returns this last week actually came from our discretionary trades. Now, those of you who follow up with us week over week, you realize that we did miss 2 weeks of the weekly roundup. As you can see from the weather behind me, we have had some serious storms, especially over the weekends that really made it very difficult to record these roundups. However, for the last 2 weeks of January, we did end the 2 weeks positive, but they were quite flat. The reality is that the market just had so much volatility baked in because of the amount of political and economic data that was coming out that we were very cautious about the number of new trades we were opening and how many trades we were closing because we felt we weren't going to be able to get the most out of our returns. So let's just hop right into it. All right. So overall, you can see our overall trades from last week were significantly green. And something I always point out to you guys, especially when it comes to our systematic trades, is that for option strat, we do keep the trades open all the way until the end of the day so that we can see how all the Greeks interacted with the trade. However, once a trade starts to perform over a certain percentage return, we do advise everyone to add a stop profit. So no matter what happens throughout the day or by the end of the day, you will return green in your account. So as you can see here, the trade went up to 50% return over like throughout the day. And so had you add the stop loss, as we had indicated inside of the group, you wouldn't have taken a $2,000 loss. You would have actually taken almost a $3,000 gain. So again, that is part of, when we are showing you the option strat, these are the trades. If there's discretionary trades, obviously I have to close them out because some of those trades could still be open for 2, 3 more months. And because they have both short and long legs, one leg may be expiring in a completely different expiration date than the longs. So I do close those out when I say to the group that I'm closing them out in my account. But the main thing that you have to know is that with the discretionary trades, we are calling out in the Discord when to add a stop loss or a profit, a stop profit, so that as your trades are developing in their returns, they are not giving back all of your profits. You should not have a trade that is up $3,000 that ends the day and you are down $2,000. That means that something wasn't communicated clearly, or maybe you weren't able to see the call outs, but we tried to work together. And again, we had a lot of earnings in the last week. And because of the fact that most of the earnings were giving us, even when they were positive, we were getting really negative reactions in the market. We did indicate to everyone that things like our IREN and Hood and VRT, that they were just they were green enough that it really wasn't worth us holding on to those positions and then suddenly letting out all of our green turn red because of negative earnings. And that was to our benefit because, as you will see in the charts, Hood and IREN had very negative returns on after their earnings call. So let's just check out from the Discord what it was that we were looking at or closing in this last week. So something that we love to trade is something called the short straddles. This is something that not many people utilize or teach, but I do think that this is probably one of the most important strategies. If you have an account that is significantly lean towards holding shares and less so about actively trading an array of different option strategies. So if you have a 100 or $200,000 account or more, you should not really be trading the entirety of the account with short duration options trades. You should be holding as part of that, a part of your account in longer duration trades like shares, and then utilizing options against those strategies. Now, most people teach when you have shares to be doing things like selling out the money covered calls or out the money cash secured puts, or stock secured puts. And I personally don't teach that very often. It's not that I hate those strategies, but those strategies really aim to kind of increase your returns at around 10 to maybe 15% um, above whatever it is that you have made on your shares. But the problem is that if you really are trying to grow a smaller account, something like a short straddle, when it is executed correctly and with the right trade management, can actually allow you to return about 100% return over the duration of 1 year on the value of those shares and allow you to be able to scale in. So let's just look at the charts as well while we are here. So I showed you that, you saw in the trade management that we had the SoFi trade with the short straddle. And one of the things I do want to indicate to people is that here you can see SoFi had a very negative turn, and we were kind of expecting that we could have that because we had these equal highs that could not actually come to the ultimate high or back above the top of the range. So we were expecting that we could end up with a healthy pullback. Of course, we weren't necessarily targeting that would come all the way back down to the 20 level, but that was really irrelevant because having that short straddle actually still returned positive gains on this drop, as you can see. Now, it didn't make us millionaires, but of course, making a 15% return and making $85 on the position by itself really couched people. Since our current average on our shares is is actually around $28. So, we would have lost obviously about $6.50 per share if that was also your average. For some, we've been averaging much longer over the last 4 or 5 years, but this basically allowed us to cover a significant amount of drop in the share value while allowing us to hold on to those shares without any kind of negative feedback. Now, we were only in this trade for about a month. So if you're making $85 a month on a simple trade that's not impacting your shares, well, that's not it's not making you millions of dollars in this particular situation, but it is allowing you to wait out the bounce on SoFi without having to constantly manipulate your shares. And it does allow you to scale in at a lower price, which right now would be a very good idea on SoFi. Uh, and the same thing on APLD. With APLD, we've been scaling into shares since it was down here at the $3 mark over the last year and a half. And those short straddles have returned us well over $1,500. So, on a stock that really is only valued at $38 currently, being able to generate an extra $1,600 is quite a significant return. And as you can see, something like an APLD has continued to go up. Now, it's very similar for Rigetti, for Lemonade, for some of these smaller valuation stocks that do have a lot of volatility because of the fact that they are lower cost. So it is easy for retail investors to really be able to scale up in their purchases. But one of the things we do tell people is that, yes, it gets really nice squeezes to the upside, which Gamma allows us to play that upside positioning. But then you do get a really nice return to the trend line. And if you are playing those short straddles or call calendars in a rotation, you are able to make some significant returns on your shares. And so we were able to participate in that this last week. Another trade that we closed this week is SDNK. Now let me see if I can find it in the list. Maybe I went down. There it is. So again, for those who have been watching the weekly roundups, you know that we have continued to scale into call calendars as the price goes up, but SNDK has moved very, very rapidly. And so we haven't really made the most on this stock. Usually when we're playing the call calendars, we really are looking for that 200-300% return. And this time we haven't been able to achieve that. Most of the time that we are closing the strategy, we are doing that for these 70-80% return because it's the center of your calendar that really gives you the most amount of profit. So when you kind of zoom past the calendar too quickly and you still have a lot of duration on that short position, it does make it difficult to really squeeze out those gains. Now, we do also have call calendars at the 520 and up above at the 600. So for those who have continued to scale in as we have moved up, then they have continued, they have other positions that will continue to benefit from this very violent move to the upside from SNDK. But for those who are just managing along with us, we have been a little bit more modest in our returns, looking at 70 and 80% returns on those call calendars, which here was about a $235 return on that trade. Now, we did have a lot of other positions that we did manage, just trying to take in some extra credit as things have kind of pulled back, but we didn't close any of those positions. And then, as you can see here, we did close out our IRN positions and our hood positions because last week earnings were coming out. And probably had we held these positions past earnings, we would have given back, if not all of our gains, a very significant portion of our gains. So I was happy that we decided to do that and be able to take some of those profits off the table. VRT continues to be one of our highest paying return stocks. That has done very well for two reasons. VRT has been on a natural kind of bull run over the last year and a half. But the other thing is that it trades clearly on gamma. So when we have very clean gamma levels, it is worth it for us to kind of heavily lean into some options positions to really bank those returns. And though I did say before that I don't often play short puts, you can see that here on VRT, I did in part because number one, I could play the short put quite close to the current price because of the extremely strong thesis we had that the price was going to be bullish. And as you can see, in just a few short months, that is already 70, almost 80% decayed and has returned us nearly $1,000. And that wasn't our only position on VRT, and that has those positions have continued to pay us very, very well. You can see here, the gamma level for us was 205. That hit yesterday. Our March gamma level was down at the 190, but potentially because we had already tapped near the 205, come down and then popped back up. Gamma may have changed for March, so we will reevaluate that. But the nice thing is that you can see that VRT has just been moving very clean, all the way from this origin move, all the way up through from the $50 all the way up to the 200. And we have continued to benefit strongly from this overall bullish trend. And that's been very positive for us and those who are trading with us. So thank you guys for trusting the callouts. Then let's continue to move on. So Qualcomm has been disappointing. This trade we didn't manage. It was really looking for a very particular squeeze into the February OPEX. It was not a massively expensive trade. In part here, it is showing a $100 loss, but actually, in fact, this trade was only worth $50. So we only took a $50 loss. The reason it's showing that at the moment, because the trade was still live, that there was 150% loss or a $100 loss is because there was a significant amount of volatility just pumping on Qualcomm because of the fast downtrend. However, when you buy to open a strategy like a debit spread or a diagonal debit spread or any kind of debited position like a long butterfly, the maximum you can actually lose is whatever you paid to open the strategy. But oftentimes, because of the amount of volatility that's moving around on the stock at a particular time when it's open, it can show you kind of an irrational valuation for its current position. But in fact, that's not what's happening. And I did point that out to everybody that it was showing a bizarre loss. But that's not accurate, that the max loss was what we paid to get into the trade. So one of the other trades that we have been taking are these call credit spreads on Microsoft. And one of the reasons is because early on, oh, I thought Microsoft was up here. My apologies. Um, One of the reasons is because there was a moment in time in which oh, this was a Microsoft chart. Okay. There was a moment in time where it looked like there was a potential for Microsoft to bounce off of a key level and potentially to give us a very short duration upside move. However, that did not transpire. And so here. So we were expecting that it could come down into this fractal and then maybe bounce back up and actually clear out this negative um, supply zone. But it did not do that. The supply zone did actually flush us down further into the Microsoft price gap. The long butterfly that we had positioned was going to fail. So instead of taking a loss, we managed that position and we turned it into a call credit spread. Now, because the drop, the consolidation and drop on Microsoft has been so violent and lasted almost 3 full months, we have actually just been able to roll out that call credit spread over and over and over again. And you can see the call credit spread is way up here. And so we've just week over week just been taking in an extra $50 just to kind of compound some gains while we're waiting for some other underlyings to find a clean base before trying to scale back in to long positions to the upside. That's a nice thing and a key thing that everybody should know about trading multi-leg option strategies is that when your thesis just becomes clearly wrong, especially if you can figure that out very early on in the trade, like here where we were expecting, okay, this potential to come back up. Quite clearly, it did not do that. So we don't need to sit around in the trade and pretend that, we're not seeing a rounding top here and that we're not getting a push down. That would just be silly of us. And we would be expecting to kind of throw away our money. But by very quickly being able to turn around and flip the direction of the strategy from a bullish strategy to a bearish strategy, we were able to actually start making money on the strategy from the opposite direction. Now, you don't want to just be doing that willy-nilly, like, oh, I'm wrong, let me change it. Oh, no, I'm wrong again, let me change it. You really have to have a clear thesis as to what's going on, why it went wrong, what you missed, A, B, C, D, so that you're not just moving things around and then compounding losses instead of, taking a small paper cut and then compounding gains as quickly as possible. So LRCX, that's another one. We have just been playing a number of trades on this squeeze up that has continued to do phenomenally well. You can see here that we had a 120% return on this trade. This was one of about 4 or 5 positions that we were in on LRCX, and that did have a really fast squeeze to the upside. And so we were glad for this pullback here that really positioned us well because as you can see, our call calendar was at the 195. And as I always say, with the call calendar, you do have this kind of tented profit zone. So, if you're a little bit above or a little bit below, you are still in that max profit region. But if you go too far away, either to the downside or to the upside, then you do start to potentially see losses. And since we had already tested this 250 area, we did really want to be cautious on how this was playing out. Something you can see, we were really focused on this upward trend channel, but we were expecting that we'd get a little bit more downside before the top move to the 250 and then maybe back down to the 220. Obviously, we stayed pressing to the upside much longer and then got a very fast push down, but thankfully we pushed right down into our calendar area. So we just decided to take profits because this trend line has just been such solid support for LRCX. We didn't want to get a strong push off and then end up giving back most of those gains, which would have happened to us now that LRCX is at this 230 area. So congratulations to those that took that trade. And then, yeah, so those are just some of the trades. We also had trades, um, as I mentioned, on Hood and IREN. We can just look at that really quickly. So you can see that had we held through last week, we would have just been forced into this very strong downside move. Now, of course, we had this support level and IREN has bounced back up slightly, but there's no reason if you're up at the 60 to wait for the price to go all the way down to 36 to decide if you want to close your positions that are already up significantly. Hood is also looking quite similar. So here you can see that, we had these equal highs. And for us, we always say weak equal highs, which means that you have a high here and then you have a second high, which is lower than the first high that you have these. Some people call it a double top, but it's more proper to call it a weaker equal high. And that usually will run out two protected lows. So we had two protected lows here, which it did do. And then it had a really nice bounce up, which we participated in. But then this push up could not take out the previous highs. So what we would have expected here, if we were expecting Hood to show strength, we would have expected to see a pullback into the zone, but then into the range and then another push up. Obviously, when this candle was followed by three more red candles, and that was clear that Hood was going to have to drop down into a more significant zone in order to really pick up new buyers. It's clear that for Hood, just the overall narrative on everything relating to crypto during this period has been bearish. So you didn't need to necessarily have a thesis just on Hood. You could have looked across the board on everything relating to crypto, just demonstrating a lot of weakness. But even if you just wanted to use technicals, then you should have been expecting, at least from these equal highs, run two protected lows, which we clearly saw. And then when we tried to come back up and we could not reach back up to the highs, that we were going to get a deeper drop on Hood overall, which we saw. So I think probably one of the big things now, just now that our we have talked about the positions that we were in and closing is, what's happening on the mining and minerals. That's an area that people keep asking a lot of questions about. And I think it's really important. So when you have bull cycles on metals and minerals, those are really long bull cycles. So we have been in a strong bearish cycle for a very long time. We did expect that the Russia-Ukraine situation would squeeze us out of that, and that is significantly what kind of helped gold get its first kind of move to the upside. But because of the lack of overall investment in the metal space, we didn't see that across the industrial metals. So we didn't see those sharp squeezes yet on things like, let's say, copper. Like here, you're seeing, if we put it on a slightly higher time frame chart, we had a lot of consolidation all the way really until 2025. So we had already been sitting through the Russia-Ukraine situation for a while and frustration with China. You can see the same thing. Uranium had a faster move, and gold obviously had a faster move because of its connection to like as a currency metal. But if we look at things like copper, even silver, which is also considered an industrial metal, we had a lot of flat before we had the squeeze. Now, last year at the beginning of the year, we did indicate that, gold had such a big push, and the correlation between gold and silver was so negative that it was likely that silver was going to have a massive squeeze back towards a kind of equilibrium point. The equilibrium point we were looking for was somewhere around 75 and 80. So most of our positions for all of last year were really targeting that 80 level. We did not participate in that last squeeze to the 100, 110. We had already made a significant amount of money on the way up. So we really wanted to wait until we got some correction. Now we've literally corrected to where we were targeting last year. And so, we saw a lot of those metals in the last couple weeks have these really nice pullbacks into a more healthier price level and range level. But, the question is this bull trend going to continue? And yes, because I think that we are in a bull cycle for everything we're correlating to metals, mining, and minerals. And not only that, because of the fact that China just has been the dominant presence in everything relating to refining metals, that other countries are now seeing that it is imperative to their own kind of safety and supremacy and dominance to be able to onboard some of their own refining and to be able to onboard some of their own supply chain in relationship to those things. So there's been massive investments in mining and in refinement and back into the energy sector, which can now allow for that new for that bull cycle to persist. Now, again, you want to be getting into things when they're at really good prices. So something we did call out more recently is the ETF MOO, which is an agriculture or agribusiness um, ETF. And the reason is because things like fertilizer or things relating to farming or agriculture, anything relating to products that are utilized will continue to increase in price just because of the overall cost of just the minerals required to keep the fertilizer and the soil and the land and the seed, the value, their value high. Those products really require a significant amount of money. So, we were looking at this chart and it was very clear that, we were likely going to be of this, popping out of this trend channel and then, or this downward trend line, and then getting a really strong move up. And we did get a really nice pull back to the range. Thankfully, we didn't even have to come all the way back to the trend line. And then we got a really strong bounce up. And so we believe that, that can continue to happen and that we can continue to see a move all the way up into the 90s, maybe even more than that. But of course, we do need to reevaluate when we see it get to that price point. Um, so those are ways that you can continue to participate in these different trends by not trying to chase what has already moved, but by trying to find aspects of those sectors that haven't yet participated in the squeeze that are likely to participate in the squeeze. So another, really good example of that would have been something like something like a copper, which also had a lagging response opposed to something like a gold. Same with things like palladium and platinum. A lot of the metals, one by one, had their squeezes. They didn't all just squeeze simultaneously, and they had really nice breakouts from downward trend lines and from really long corridors. And there continue to be a lot of different aspects of mining, minerals, metals, agriculture that, still look like they're just now breaking out of these long-term bases. And there's still a way to be able to participate in those trades. Another area that, we continue to focus on and talk about is the space sector. You can see that, these stocks are only just now kind of getting to those like breakout prices. They continue to perform extremely well this year. This is a weekly chart. So you can see that, this is the stock we've been participating in since the $5, $6, $7 range. And now we're starting to see it get back to those highs. We do expect it to get back to the 25 and then pop up. Red wires, another one. Whoops, let me give you the right. that has continued to do really well. And we had a really nice couple week run on at the towards the end of the year. We did have a pullback, but that is normal. These are lower value stocks, so they can be quite volatile, but they have continued to pay out very well for us on our positioning. ASTS also done phenomenally well, and we've been in this since the 20, 30, and $40 range. Fly is another one that is doing well in this sector. Again, some of them have had pullbacks the last couple weeks just because they have moved quite fast and quite significantly. But these areas are the area of space is an area where there's still a lot of defense spending that's going out and allowing for participation. And so, I encourage people like to take the time to, consider some of those stocks, get themselves a little bit of exposure, try and, figure out how the stock moves. But of course, this is an area where you have a lot of volatility. So when you have pullbacks, they are deep. But if you are going to hold these stocks over the next 10, 15 years, you're not going to feel all of these pullbacks over time. So, trying to figure out how to partner shares with options so that you can hold these over the long run is also really important. That way, again, you are both able to generate income on the trade, but also be able to participate over the next 10, 15, 20 years with shares on the outperformers in this kind of discovery area. All right, friends, I hope you guys have a wonderful week. Thank you for always checking back with us to see how we have done. Yes, last week was maybe not the wow performance that we normally have of the 10, 15, 20, $25,000 returns. But considering all the political turmoil with a partial shutdown, the fear of shutdown, the FOMC meetings, the election of or the nomination of a new Fed chair, the reaction of Powell to the Fed chair and how he will continue to participate in the FOMC board going forward, and how he will step down as chairman, just the legal battles between the government and both Lisa Cook and Fed Chair Powell. And then just wider discussions around what we would do with Iran, what was happening with China, what was happening just overall in the cost of in the oil and gas industry after the takeout of Maduro. So there was a lot politically going on that was causing a lot of instability and conversation that did give us those higher VIX numbers the last couple weeks. But we didn't want to get shaken out of really good trades. We just wanted to calm down and make sure that we weren't overly exposing ourselves, but also allowing ourselves to participate on really good setups. So for everybody that's in the Discord and you're getting the call outs real time, hopefully you were able to make some good money on those trades. And yeah, I hope you guys that, we continue to have a really good week. The week has started out really well for us with our systematic trades and with some of our other discretionary trades. So hopefully you guys are participating in those, and we will see you in the Discord. All right. Bye for now, friends.